Very good evening, members. I, C. Ankita Mangla, Secretary FRRB, welcome you all to the webinar series on commonly found non-compliances on Ind AS and Companies Act 2013, being organized by FRRB. We are delighted to have the presence of Honorable President Sir, C. Ranjit Kumar Agarwal ji, Honorable Vice President Sir, C. Charanjot Singh Nanda ji, Chairman Sir, C. Vishal Doshi ji, and Vice Chairman Sir, C. Dayanivas Sharma ji. In today's webinar, sir, we are overwhelmed with your presence and we heartily welcome all of you in this webinar. Today, we also have with us very eminent speakers and panelists for the session. C. Anand Bankaji, C. Santosh Malarji, and C. Himanshu Kishnarwalaji. Vishal sir, I invite you to deliver your welcome address.
Thank you very much. Very good evening to all the participants who have joined on this webinar series with respect to the compliances on Ind AS and Companies Act, the commonly found errors. A very good evening to respected President ICI, C.A. Ranjit Kumar Agarwal ji, the Vice Chairman of the FRRB, C.A. Dayanivas Sharma ji, the panelists, the experts who are going to respond to our deliberations today, C.A. Himanshu Kishnadwala ji, C.A. Santosh Malarji, C.A. Anand Bankaji, the Secretary of FRRB, C.A. Ankita Manglaji, and the entire team at the FRRB. Friends at the Financial Reporting Review Board, what we do, I thought we welcome the Honorable Vice President who is presently out of India and has taken time out to join us in this webinar. Welcome, sir. So, sir, at the for the participants at the Financial Reporting Review Board, we review the financial statements of the listed companies as well as the large corporates. And we follow a three-tier approach. The approach being that at the first level, we have the technical reviewers who review the financial statements for the various compliances with respect to the accounting standards, with respect to the auditing standards, with respect to the various laws, like is the Companies Act, the SEBI, or any specific laws pertaining to any industry. Thereafter, we have the Financial Reporting Review Group, which reviews the comments of the technical reviewer, and then the groups submit their reports to the board, and thereafter the board considers these reports. So this is a three-level hierarchy which we follow, and till date we have reviewed a large number of the financial statements. So we take suo motu cases based on certain sampling techniques that we use at the FRRB. And in addition to that, we also take cases which are referred by the regulators for any specific observation or non-compliances which are there. Since the leadership is here, I would not like to take much time because we would all want to listen to them, but I'll just give a background about this particular webinar, that this was something that we were wanting at the FRRB. We regularly come out with publications on the commonly found errors with respect to the accounting standards, Companies Act, the CARO, and the related applicability. And this time, starting April, we are into the season of the listed companies into their financial statement compliances, the last date being 30th May. And we thought that this would be the apt time to create awareness, not just amongst the auditors, but also the preparers of financial statements, to ensure that there are minimum of errors that are there in the financial statements for March 24, which would now be signed off by them. So that was the objective. And when we started, we wanted to do a 2-hour webinar, but considering the observations that we had, the points for discussion, we thought that 2 hours would not be sufficient, and therefore we have arranged for a series that is 2 days, today and tomorrow, 2 hours each for deliberation on the commonly found errors with respect to Ind AS and Companies Act. So with this, once again, I welcome you all to this webinar series, and I would now request our Honorable Vice President of ICI, C.A. Charanjot Singh Nanda ji, to please give his words of wisdom.
A very good evening, ladies and gentlemen. The Honorable Dynamic President of the Institute, C.A. Ranjit Kumar Agarwal, who's coming back from Jaipur after meeting the Finance Minister. They had a very nice session. I can see the chairman of the Financial Reporting and Review Board, CA Vishal Doshi, the vice chairman, CA Dayanivas Sharma ji, the speakers, three speakers of the day, Mr. Anand Banka, Mr. Himanshu Kisanwala, Mr. Santosh Malar, and all participants have come here to go home more enlightened. Ladies and gentlemen, you are all aware that we were set up an Act of Parliament way back on 1st July 1949 to ensure that the audit quality is enhanced to the maximum limit. Now, when you go and look at the published accounts of certain entities, you find that there are certain fallacies. There are certain such shortcomings which need to be brought to the notice of all the stakeholders. And therefore, I remember 7 years back, I was a part of the FRB, and then they started doing seminars on commonly observed errors. You are all aware that in today's time, the regulators, apart from ICAI, have become more vigilant, and they want to nail chartered accountants even on slightest of their mistakes. So in order to ensure that they give an error-free report, a report that gives benefit not only to the stakeholders, but to the regulators and government, so that they're able to effectively draw out the important issues and points. I'm reminded when I was a part of the SCODA Committee on Disclosures and Accounting Standards in SEBI, the SEBI chairman, the moment he met me, he always asked, sir, when you look at a published set of accounts, do you feel all across the globe the inference that is drawn is homogeneous? So today's seminar will put in perspective the thought process of all the regulators who want that each and every treatment, each and every accounting treatment ultimately gives birth to the similar inference which they intend to draw. It has to be a homogeneous inference across the board, across the globe. FRB is doing a yeoman's task. Mr. Chairman was just discussing how they move ahead, setting up groups, ensuring that people from all walks of life come, contribute, and ensure that any smallest error be pointed out, although the cognizance may not be taken, but the error be communicated to the auditor. And in this line, they have thought of conducting a seminar, and I welcome it, and I'm happy that the entire thought process now is on enhancement of audit quality, which is our basic premise. I want to give this webinar all compliments and success, so that all people who are attending go home more enlightened, putting at rest all their doubts that may have arisen during the course of their professional avenues. Thank you. Thanks a lot.
Thank you, Vice President, sir. And thank you for reiterating our, I would say, our efforts for improvement of the audit quality, which is the vision or mission of the ICAI. Thank you very much for your kind words, and thanks for joining from Korea. I would now request our Honorable President of ICAI, CA Ranjit Kumar Agarwal ji, to kindly give his presidential address. Over to you, sir.
Thank you very much, Chairman FRRB Vishal Doshi ji, Vice Chairman Dayanivas Sharma, Honorable Vice President Charanjot Singh Nanda ji, who joined from outside India. Thank you very much for giving us a chance to interact. This is a very pertinent and important topic which we are discussing today. FRRB Financial Reporting Review Board set up way back in 2002, when you remember Enron happened, and the Arthur Anderson, a chartered accountant firm, was questioned, and later on the firm was finished because of the one mistake of Enron. That point of time, our leadership thought we have to self-review the work done by our fellow chartered accountants. And that's what this Financial Reporting Review Board was set up as a self-regulatory measure, neither recommended by the government or not by any regulator. The institute at its own has set up this board in 2002. And since then, this board is reviewing the financial statements audited by the fellow chartered accountant. And they are ensuring the quality, the contribution, which are expected from the chartered accountant in the financial statement, based on the various accounting and auditing standards. There are processes, there are lapses, there are various issues as far as reporting done by our members. And this board has a very robust mechanism wherein there are 3 layers. At 3 layers, the review process being done. And wherever the negligence of the auditor is found, they send them the advisory. On the other hand, wherever gross negligence is happening, the matter is being referred to the disciplinary proceedings for taking it forward. So far, 2002, since then, more than 1100 review has been done by this board. And out of this 1100 review, almost 16% has been referred to the disciplinary proceedings. Now, myself being the vice president sitting in the disciplinary committee, many cases referred by the FRRB comes. And when we see the reporting aspect done by our members, there are challenges, there are awareness required, there are dissemination of knowledge is required, because the quality which are expected from our fellow member by the stakeholder, we have to live up to the expectation. And that's why the quality review of the fellow chartered accountant is the utmost priority now of every regulator all across the globe. So many issues are coming in the accounting profession across the world. So like in India also, many corporate frauds, corporate mismanagement are happening. And there are 5 layers of defense. I was discussing with another regulator, a very prime regulator, Mr. NFRA, Mr. Pandey, in a CI meeting, and we were discussing how this accounting issues can be protected. So there's a 5 kind of defense has to be maintained. The first defense will be the management. Second defense will be the audit committee. Third defense will be the auditor. Fourth will be the investor or shareholder. And the fifth will be the regulator. On this line of hierarchy, the defense has to be seen. And as far as the quality aspect of the auditor is concerned, it has to be on the utmost priority and no compromise. Not a single item of compromise can be expected if as far as the quality of auditor is concerned. And that's why this board is working very hard, suo moto, just to review the various facets of the auditor while discharging their duty as a true and fair and true and correct. And in the process, this board has now come out with a various publication, various study material. After a long time, I think after a very, very long time, this kind of webinar is being organized by this board, a very thought-provoking thoughts given by the chairman, vice chairman, just to disseminate the knowledge, what are the common errors, what are the negligence which we have to avoid, and what are the negligence or gross negligence. There is a thin line between negligence and gross negligence, which the auditor has to see, and then they have to work, and then they have to report. So I think this webinar with so many experts is there will be an eye-opener to many auditors, to what kind of mistakes they are making knowingly or unknowingly. And we have to be ensured that all these quality aspects of the auditor has to be strengthened. We have to disseminate the knowledge. We have to upskill and reskill the quality of our member. And I always used to say, there are 3 important things as far as audit profession is concerned. Number 1 is quality. Number 2 is also quality. And number 3 is also quality. Quality, quality, and quality is the only word which we have to ensure. And if the country is going forward on the verge of this $5 trillion economy, the expectation from the audit fraternity is huge, and we have to live up to the expectation of the various stakeholders. I compliment the FRRB board led by Vishal Bhai and Daya Bhai for taking this kind of initiative and disseminating the knowledge to the various stakeholders and the auditor in particular. I wish this board and this program a grand success. Thank you very much.
Thank you very much, President Sir, for your words of wisdom and especially highlighting the 5 lines of defense. That is the management, the audit committee, auditors, investor, and regulator. I believe that your words would definitely have had a major impact on all the participants, and thanks for appreciating the efforts of the board. I would now request the Vice Chairman, C.A. Dayanivas Sharma ji, to kindly propose a vote of thanks for the President and the Vice President ICI.
Good evening, friends, and thank you, Chairman. Honorable President of the Institute of Chartered Accountants of India, Ranjit Kumar Agarwal ji. Honorable Vice President Charanjot Singh Nanda sir. All the 3 speakers today. Rather, it is something very important, President sir. The 2 aspects which you spoke very catchy in the process was the 5-layer approach which the Chairman commented upon, and the second part is the 3 requirements, which is quality, quality, and quality. That is the only thing which is actually going to define the profession in time to come. Respected President sir, we really feel elated that the moment the Chairman, Vice Chairman FRRB proposed that we should hold this kind of webinar at the beginning of a time where the closing is done for the last financial year. For every end, there is a new beginning. That is the way it is being told. And most importantly, under your leadership, what is being deliberated time and again is start the navigating machine at the beginning of the journey rather at the end of the journey. This thought, which actually gave us a positivity, saying that before the year end financials are being signed, why not we go back and discuss the previous errors which are being noted. They may not be intentional, they might be unintentional, or it might be erroneous situation which has come. But the most important part is a smaller aspect when it's been ignored by a learned auditor, it is always seen as a bigger thing which has been missed out. This webinar, with your approval and a process which we wanted to initiate this time was during this time is to ensure that the people actually get the knowledge and be aware of the small gaps which are being noted every time during the review of FRRB engagements. Sir, we thank you very much for joining us, and we know that fact that you have just interacted with the finance minister, and the discussion from your corridors as a president, which is going across the length and breadth of the country, is on the transparency of reporting, governance, which is to be measured and mapped every time, and most importantly, we have to see the financial statements are error-free. So that is something which we are carrying forward and taking that agenda, considering the factor that the times to come are going to be much better, where new financial investments are going to come, and our existing auditors as well as the companies report rightly under the financial reporting framework. So we thank you very much, sir, for giving this direction and coming and addressing all our members with your thoughts. Vice President, sir, we can really understand and appreciate that you have moved out from the existing meeting to ensure that you come, share your thoughts with our members, so that the continuity of thought, which is from the council members to the Vice President to the President, and including the Secretary of the committee and the committee members, are actually the thoughts which are given by the Honorable President and Vice President. Thank you very much, sir, for pulling out your time and giving that words of wisdom to our members. And finally, our speakers who are very learned, they have been participating in this learning and teaching experience. I compliment Himanshu Bhai, Anand, Santosh for always ensuring that they are available to share their knowledge with our members at large. This ecosystem of ICI is, a process where we groom our competitors also in a true sense. So that is the quality of this profession, and that is how you speakers who are coming forward and sharing your experience is actually adding value to the entire process. So, Chairman sir, on behalf of you, me, and the entire board, we thank President, Vice President, and the speakers today to join us. And we assure that this 4 hours of learning is going to be a very quick learning experience for all you people. Thank you very much, all of you. Thank you, sir.
Thank you, sir. Thank you, President, sir. Thank you, Vice President, sir.
Thank you, sir. Moving on to the session. Before I hand over the proceeding to the panelists, I would like to introduce our panelists to the participants. C. Anand Bankaji, who is a fellow chartered accountant with PhD in finance and author of 9 best-selling books and a faculty for course on IFRS and Ind AS. He has been a speaker at various professional forums across India and other countries. He is special invitee on Accounting Standard Board of ICI, a technical reviewer for FRRB and for the ICI International Research Awards. CA Santosh Malarji, who have passed his CA examination with an All India merit rank and has more than 20 years of professional experience. He has extensively worked on IFRS and Ind AS audit and conversion engagement for several large companies. He is also a special invitee on Accounting Standard Board and has been part of several technical group of ICI. CA Himanshu Krishnad Balaji, who is rank holder in both CA Inter and CA Final examination. He oversees the audit and assurance practice of firms, particularly audit of large companies, Ind AS implementation, convergence of financial statement from IGAAP to US GAAP and IFRS. Welcome you all. Now, Vishal sir, I would like you to commence today's webinar.
Thank you very much. And friends, what we have done is that we have this commonly found errors. And the normal way it would be a presentation, but we thought rather than a presentation, let us make it in a panel discussion, a Q&A form. And so we would cover the various standards, the provisions of Companies Act, Schedule 3, over the 2 days, today and tomorrow. And so we would have the same panelists and tomorrow also for the same time, 5 p.m. to 7 p.m. So my first question to Himanshu bhai. So what has been observed was with respect to loans from related parties, which were callable on demand, and the repayment terms were not stipulated. So what would be the classification requirements for such loans from related parties?
Yeah, thank you, Vishal, and pleasure to be part of this panel discussion. To get to this question right away, so the question is, if you have a loan from a related party which is callable on demand, it is basically therefore a presentation related issue, and we have to look at Ind AS 1, where you have got paragraphs which say that a liability is classified as current if it does not have an unconditional right to defer settlement for at least 12 months after the reporting period. Now, if you have a loan, now whether it's from a related party or otherwise is not really relevant, but if you have loan which is callable on demand, there is a right which is there with the lender that he will be able to call back within that 12-month period. So therefore, it will need to be classified as a current liability. In the past, though, if there is a record that they have not called it back for maybe 2 years, 3 years, but if it is callable on demand, it would still be classified as a current liability.
Thank you, Himanshu bhai. And in fact, the FRRB, when they were reviewing the financial statements of one of the company, in such case, the classification was shown as non-current. And that is why this question was asked to clarify the correct presentation requirements. I'll come to Santosh bhai. Sir, your question is on Ind AS 16, property, plant and equipment. In case of a company, as per the accounting policy of PP that was mentioned, subsequent expenditure is capitalized only if there is increase of future benefits from the existing asset beyond previously assessed standard of performance. Santosh bhai, whether this is in line with the requirements of Ind AS 16?
Good afternoon, everyone, and thank you all for giving me the opportunity to speak on this panel discussion. So Vishal bhai, coming on to your question, basically the accounting policy that you just read is probably a hangover of the old, accounting standard or the IGAP, era. Under Ind AS 16, the subsequent recognition criteria is based on two criteria. That is, if there is a probability that future economic benefits associated with the item will flow to the entity, and of course, the cost is reliably measurable. The standard gives an example, and this is a very commonly cited example of an aeroplane where you need to have a major overhaul after every 3 or 4 years. So you don't assess whether the life of the aeroplane will increase or that aircraft will increase beyond the earlier state. But what you assess is the part what you're replacing. Let's say if the overhaul involves any kind of a replacement of a part. Let's say if the chairs are replaced, then what you would do is you would capitalize the new chairs that you have installed in the aircraft, and you would decapitalize the WDV of the old chairs that were capitalized, of course, under the component approach that we were earlier, you would have capitalized. So all in all, the policy that you mentioned is not in sync with the requirements of Ind AS 16, Vishal bhai.
Yeah, thank you, Santosh bhai. And like you rightly mentioned, that there are now under Ind AS 16 the recognition criteria for the subsequent expenditure which has to be met for capitalization to be done. Coming to Anand bhai. Anand bhai, it was observed from the notes to the financial statements that there is sale of FCCD, that is fully and compulsorily convertible debentures. It was further noted that consideration towards sale of FCCD was higher than the investment value. On perusal of the annual report of the company, no additional investment was found towards the FCCD during the year. What are the disclosure requirements as per Ind AS 1 that the company should have complied with?
So firstly, thank you so much, Chairman sir, Vice Chairman sir, for having me here, and good evening to all the participants. So Vishal bhai, coming to your question, firstly, I would like to say that Ind AS 1, it does not specifically give format of financial statements. That comes from Schedule 3. But it gives minimum line items or minimum items that you need to disclose, whether you disclose it on the face of it or you disclose in the notes to accounts. But you need to disclose those specific line items in the financial statements. So when you invest in these compulsorily convertible debentures, okay, so any of your such investments, when you sell, and then there is gain or loss on sale of such instruments. In that case, there's a mandatory requirement to disclose, the details of such sale and what is the gain or loss on sale of such instrument. So hence that disclosure should have been given as per Ind AS 1. Yeah, that's my response. Thanks.
Thank you very much, Anand bhai. And for a change, when the captain is playing from the other side of the pitch, the vice captain also have to start playing. And the toughest question goes to Himanshu bhai. So the toughest ball is coming to you, Himanshu bhai, which is very simple. We were having today a FRRB meeting and we were just noting certain very interesting discussions which we had. But there are certain fundamental things which we are actually missing out. I think Santosh will agree, Anand will agree, you also will agree. When we are doing the audits and concluding certain financial statements, small things, because the team works on the engagement. Am I right, Chairman? The team works on the engagement. And what happens is we just completely rely on certain things and just move on with the fundamental things we miss out. We focus on the larger things. So now the question is coming on the fundamental thing. See, there are instances which are being noted where the questions have come with regards to the profit and loss. In the profit and loss account, interest expense, can it be netted off with interest income? Very simple. In the disclosure requirement under Ind AS 1, what should be a stand which is taken? Because fundamentally, certain things are going wrong. Himanshu bhai, we want an input from your side on that ground.
Yeah, thank you, Dayanandji. Yes, this is a fundamental question, and when a company tries to decide whether to show interest gross on both sides or want to net it off, more than the accounting angle, no, the companies actually think of the taxation angle, because there would be something like disallowances, allowances, or tax rates which are applicable when you have to show on both sides or something. So typically, a company may always believe that if I have interest received, if I have interest paid, let me net it off and show it at one place. However, when you come to the Ind AS, no, there is specifically 2 or 3 places which will not allow you to do this netting off. And the first of this is Ind AS 1 itself, where Ind AS 1 will clearly tell you that and that is paragraph 32 of Ind AS 1, which says that the entity cannot offset assets and liabilities or income and expenses unless required or permitted by any other Ind AS. Now, this is very categorical in that paragraph 32 of Ind AS 1. Let me also tell you that Ind AS 1 is a standard which people normally don't read because it's just a disclosure standard. You only read that Schedule 3 and you forget to read Ind AS 1. So that usually happens, that the basic things you forget and you tend to get into more complex things. So if you ask someone something on financial instruments, they will know what is impairment recognition. But when it comes to this presentation, people do miss out this particular thing. So paragraph 32 clearly says you cannot net it off. If you have netted it off, it is wrong. And frankly, besides the FRRB, which has clearly, I believe, said somewhere that you cannot do this, I believe there is also a ROC the decision where they have penalized the audit firm for allowing such a net off. There is a ROC decision which is available in public domain on this particular point. Even if you go to division 2 of schedule 3, which is on Ind AS, they also clearly says that you have to give the breakup of your other income and finance costs. So which again means that you are not really allowed to net off. Now, this is something which I believe all the people on the webinar should very carefully take note of. I am sure more than half of them will have to undergo a change in their financial statements.
Sir, इसका मतलब तो ये हो गया, the life will become very simple when you actually show a netted off balance. एक पेज भी नहीं, 2 लाइन के अंदर profit or loss. Just disclose that and close the financial statements.
Correct.
Am I right?
Correct.
So the fundamental,
Correct.
Anand also is smiling a big way, though I think Santosh is very serious in his thinking. Can it be that the net off can be shown only profit or loss? क्या Chairman sir? In the entire financial statements.
In fact, Himanshu bhai, just to add, or I would say, the thought process, many times, we all interact with professionals. So they also try to, argue that from the cash flow perspective that, I've received from X borrowing and I've given to Y. So then, there is actually a nexus between the interest income and the interest expense. Second thing, again, that in case of fixed deposits or some investments that are made and there is a premature withdrawal and then, there is a penalty or some interest reversal that happens. So can you just share some situations or maybe highlight that where it can be permitted a netting off and, or where about this nexus of the income versus the expense?
So I'll tell you, say for instance, you are in a, say, a export business and you take that packing credit. Now, if you take a packing credit, the money has to be used for actually doing the export. A lot of companies, what they do is on a temporary basis, they invest that money in fixed deposits or mutual funds or something. Now, therefore, clearly you have an income which has arisen. On the other side, there is a cost of the packing credit. Now, if they show this to a banker, the banker will say that you have not used the money for export, but you have invested in a fixed deposit. So this is one reason why a lot of companies in export say, let me net it off, so that the presentation shows only as a net expense. Now, clearly that is no accounting angle, but this is a business angle, which is not clearly allowed. And when people have come to me with a query that can you do this, I said you can do this, but as an auditor, you will have to point it out in your report that this is done. And you have to hope that the banker does not read your audit report on this.
Perfect. I think one more final instance, if permitted, a similar issue has come with regards to import and export, which was done by one of our clients. When they knocked off. But from the RBI perspective, also again there was a different issue which raised up. So technically, what is happening is from every angle, if you see Himanshu, right, there are different aspects that we need to look at. One, undoubtedly, is the fact that compliance of Ind AS, which is very critical. Number two, when you talk about Companies Act requirement, which is again very clear. Third is again RBI compliances that are required to be done. There are multiple factors. That is the reason I said it is very simple question, but a difficult answer. And that has been actually happening in multiple places, and issues are noted. And similar, when the chairman is as a captain playing and hit 3 sixes, then at least I have to take 4 run या 2 run to ले लेते हैं. So next question is for Santosh in that matter, because now it is IPL season. I am just using the word cricket only from that perspective. So Santosh bhai, the point next to you is again a fundamental thing. What has been happening is on the face of balance sheet, right? There is a property, plant and equipment, and also capital work in progress, which is reported. And there is a movement which has been noted in those numbers, and that has been disclosed somewhere. But at the later point in time, in what are the disclosure requirements with regards to property, plant and equipment and capital work in progress as per India's requirement?
Yeah, so Dayanandji, basically Ind AS 16, both Ind AS 16 as well as Schedule 3 prescribe the disclosures. As far as Ind AS 16 is concerned, you need to give a proper reconciliation of the opening balance of property, plant and equipment, and as well, the capital work in progress. The reconciliation from opening balance to closing balance. You would also have items like depreciation, impairment, additions, deletions, deductions, write-offs, etc. as a part of that reconciliation. Now, typically, CWIP is the balance where many, at least in my experience, many companies do miss out on giving that movement. But now, since last couple of years, now that we have the revised Schedule 3, as we know that there are disclosure requirements that CWIP also needs to be, the aging analysis also needs to be disclosed. Ongoing projects need to be, the bifurcation of that needs to be given, and the progress and the expected date of completion needs to be also disclosed. So I think in the revised Schedule 3 regime, this disclosure of capital work in progress is something which has become, generally as auditors or as, finance controllers, people do pay a lot more attention to it now than earlier.
True. And I think, Santosh bhai, you will agree that day by day, the compliance of law, the laws, regulations, standards, sections have been there from existence from quite a long time. But what is happening is now the lens with which the numbers, the financial reporting framework has been looked at is actually getting a little serious. And as you rightly said, the disclosure requirement has to actually speak on its own. You don't have to go back, forward, check what is happening, where it is moving. So that agreed totally. Thank you very much for that. So one more thing for Anand bhai, because he's been smiling for all the questions which I am asking, because it is very simple, but I think equally simple to answer by you all people. So Anand bhai, the next question goes for you is with regards to investment disclosures, right? I'll just read out a specific thing for you, which actually is a very interesting one. Investment was increased in terms of number of shares as well as fair value without any change in value of investment. Are there any disclosure requirements for this? Face value, sorry.
So let me start by that because Ind AS is a principle-based standard. The disclosure requirements are also largely principle-based. That means it is the responsibility of the company as well as auditors to ensure that whatever is happening, the transactions or events, are well explained by way of disclosures. So while there may not be very specific tick in the box that every transaction is covered by one of the other standards in form of disclosure, but the standards lay out certain principles wherein you have to ensure that your disclosures meet those principles. In the example which you gave, there can be many reasons why the number of shares have increased, the face value per share accordingly or proportionately has gone up, but the amount has not gone up. Or that can be maybe you have received bonus shares, maybe it is some other transaction which has happened and you have got the shares for free in that transaction. So there can be many reasons why this has happened. So it is a responsibility of the company to ensure that they disclose the reasons why it has happened, so that the investor can understand and appreciate the change which has happened from previous year to the current year. So there is a requirement principally to disclose what transaction has happened and why the number of shares have gone up.
Yeah, sure. So Anand bhai, what you mentioned was very right, that there can be various reasons for the numbers increasing and face value changing, like a split bonus and things like that. But the explanation needs to be provided for the users to understand that there is no change in the value, but change in the quantity. So coming to Santosh bhai, and Santosh bhai, I'll ask two questions. So one by one, but back to back two questions. And definitely, since we are bombarding you with Ind AS 16, we'll continue with that. So as per the accounting policy of depreciation, the depreciation on leasehold improvements was provided over the primary period of lease or over the useful lives of the respective fixed assets, whichever is shorter. So what is this primary period of lease, and whether such policy is in accordance with the requirements of Ind AS 16?
So Vishal bhai, so firstly, let me put it this way. So let's take the example of, let's say, a retail company, a company which has a retail, outlet in a place like, let's say, Mumbai or Baroda. And let's say if I have a leasehold improvement in that store, which is leased, let's say for 3 years. The lease term would be, 3 years, and it can be probably further extended to further 3 years. When I look at it from an Ind AS 16 perspective, this leasehold improvement, I need to depreciate over useful life. Now, what is useful life? I have to consider the lease term, that is 3 years, and the independent useful life of that leasehold improvement. Let's say if it's a false ceiling or an interior work, I cannot have an accounting policy which is going beyond 3 years, because that's my primary, lease period. At the same time, if I'm estimating that if that work which I've done, that fixed asset or property, plant and equipment which I have, if its independent useful life is, let's say, less than 3 years, let's say 2.5 or 2 years, in that case, I'll have to go by shorter of the two, that is 2 years. If the primary lease period is, let's say, 3 years, and if it can be extended for further 3 years, and I recollect I think couple of years back, we had this EAC opinion where it was 3 plus 3 plus 3. And the question was whether I can use 9 years as the useful life for the interior works that I'm doing. It was one of the FMCG companies which was actually requesting for a EAC opinion. So there again, firstly, you have to look into what is your assessment with respect to Ind AS, not 16, but 116, the lease accounting standard. Whether the lease term should be 3 years or 6 years or 9 years, whether there is a probability that I will extend it beyond 3 years. First of all, whose option it is, whether it's the lessee's option or whether it's the lessor's option, or is it based on mutual, agreement. So those terms will have to be looked into. The point here is that the lease term assessment which you make under Ind AS 116 has to be consistent with your useful life determination for your interior work. In no case, I repeat, it cannot be, in no case, it can be more than the lease period that you have assessed under Ind AS 116. And of course, independently, if the asset is not going to be long-lived enough to till the end of the lease term, then you have to cap it to the independent useful life. As a disclosure, in any case, whatever you have assessed, whether in my example, it's 2 years or 3 years, that numerical figure also needs to be disclosed, because many a times we miss out on giving. So we end up just saying shorter of the two, useful life or lease term, and leave it at that. As a disclosure requirement, I think what we are saying is the standard expects the numerical years in life, the estimated useful life, also to be disclosed in that notes to accounts. I think that's also one of the points that one needs to keep in mind.
Yeah, thank you, Santosh Bhai, for I would say explaining the concept of the lease period and the I would say with an example, and also the disclosure requirements. Santosh Bhai, the next question is that it was noted that all the project related expenses. So this was a case in case of a company that was observed that all project related expenses which have been incurred prior to the date of commercial operations have been capitalized. Now this is a very I would say difficult situation across. Many times we find that there are different completion dates which are based on milestones. When we do an audit, so especially because there are project teams and there's so many other people and teams which are involved, and the different milestone based completions that are there. So it can be commercial operation, it can be trial run, it can be third party inspection, it can be regulatory approvals. So what exactly should be considered from an Ind AS perspective for the date of capitalization?
So Vishal bhai, the short answer to this is basically that, the criteria in Ind AS 16 is that you cannot capitalize any expenses beyond the point until the asset is, ready for its use in its location and the condition which is intended by the management. So that is theoretically the simple answer. Practically, of course, there are, it can be extremely judgmental, because you may have a trial run, you may have an inspection. Let's say, for example, if it's a pharmaceutical company, you may need some approvals from, let's say, US FDA or WHO for inspecting the company, whether it's good enough to produce the medicines that you are intending to do. You may have other approvals as well. So again, and even in the IGAP regime, this has been a very judgmental kind of a thing as to what is the point at which one can really say that, the asset is ready for its intended use, and there can be trial runs. Now, one has to also keep in mind that there was an amendment to Ind AS 16. I think it was last year or maybe last year, where it said that the trial run, if it is, a testing of the testing costs, that also one has to keep in mind for capitalizing. And again, we took a deviation from the IFRS, the requirements under IS 16 under IFRS. EAC was also there. I think just last volume, we had one EAC which said that one has to distinguish between what is the scope of the trial run or the test run. If you're trying to figure out whether the asset is working to its, intended capacity, then that's something which can be capitalized. But if it is a trial run to test whether the, the capacity of if let's say you're not getting enough orders, okay, you have built a plant which is capable of, let's say, churning out 1 million tons of the output, but you're not able to, initially get that much demand, and therefore you're not utilizing it to that extent. Then in that case, that cannot be the criteria for deciding the point of capitalization. So again, it is extremely judgmental. One has to look into various, aspects. the regulatory approvals, the the capacity that you have intended to, whether there's excess capacity, short capacity, what is it that you're waiting for, and so on and so forth. It can be extremely judgmental, and I think case by case one has to look into all these aspects.
Very true, Santosh bhai, and very well explained. The concept of the capitalization and the judgments that would be required. In fact, I would also request that if other panelists also have anything to add to any of the responses that are being given based on their experiences, because we have a very knowledgeable and I would say experienced panelists. Please, you can definitely unmute and chip in. It would always benefit our participants. And for our participants also, I would request that, since this is a series, we are going to come back tomorrow evening. In case you have any questions, you can definitely put it in the chat box, and we will try and share it with our panelists so that we can try and cover them tomorrow. So coming to Himanshu bhai. So again, with respect to Ind AS 1, so remeasurement of defined benefits plans not reclassified to profit and loss in subsequent periods was shown under other comprehensive income. Himanshu bhai, how is the tax impact on the same to be disclosed? You'll have to unmute, sir.
Yeah, sorry. So Vishal, this is the question where there are defined benefit plans. Typically, they are, say, actuarial gratuity measurements, where there is a difference in the opening and the closing. And this is as required by Ind AS or required by Ind AS 19, taken to other comprehensive income, and they are not reclassified back to the profit and loss. There is also a similar thing on revaluation surplus. If you have a revaluation surplus, it goes to OCI and does not get reclassified back to profit and loss. Now, if you link this up with the provisions of Ind AS 12, especially that paragraph 61, then it says that in case there is any current tax or deferred tax which is not recognized in the profit and loss, but there is an item which is being considered in other comprehensive income, the corresponding deferred tax also will go to other comprehensive income. In other words, if the defined benefit plan impact is considered in OCI, the tax impact of that, which typically would be more like deferred tax impact, will also be classified back into the other comprehensive income and presented accordingly. So one line item would be defined benefit plan remeasurement. The below that would be tax impact on the above. So both will come one after the other. In other words, the standard is only saying that you cannot compare apples and oranges. Put everything at the same place.
Very true, Himanshu bhai. And in fact, it is time to have some apples and oranges. So so in fact, this question came because in the FRRB observation was that in case of a company, the tax impact was not shown in the statement of P&L with respect to such remeasurement. Himanshu bhai, with respect to intangible assets under development, what are the presentation and the disclosure requirements?
So if you come to intangible assets under development, if you are clubbing, say, a lot of items and saying that they are intangible assets under development, would not be again the right thing to do, because you will have to first of all decide what is contained in that intangible assets under development. So a breakup of the expenses which you are putting there will need to be given. And you have to read this in line with the Schedule 3, where even if you capitalize something or treat it as under development or under CWIP, the components which are otherwise required to be shown under Schedule 3 will anyway need to be shown separately below this. So just clubbing everything here and showing one figure will not be the right thing. And again, going back to the conceptual framework or Ind AS 1, it clearly says that whatever you write in the financial statements has to be something which is understood by the reader. If you club everything, it cannot be understood by the reader as to what you are doing that. So that's one of the fundamental presentation norms of Ind AS in that sense.
Yeah, very true, Himanshu bhai. And in fact, We have also come across that, especially where there were internally generated intangible assets relating to that, there was no accounting policy that was given or any explanation with respect to such assets, and therefore, as per the FRRB process, it was flagged as a discrepancy. Coming to Anand Bhai, sir, your question is on Ind AS 12 on the income taxes. So, in case of a company, the accounting policy read as follows on income taxes: the income tax expense or credit for the period is tax payable on the taxable income of the current period based on the applicable income tax rates at the balance sheet date, adjusted by changes in deferred tax assets and liabilities attributable to temporary differences and to unused tax losses. Anand, what are your views on such policy? Is it in line with Ind AS 12?
So your last line was interesting, and sometimes I think it is inadvertent mistake, or while drafting the policies, people do not maybe spend time in reading that again and again. So the last line of what you said was something like where deferred tax and deferred tax assets and liabilities pertaining to you said temporary differences. I think, right? Attributable to temporary differences and unused tax.
Yeah. Assets and liabilities attributable to temporary differences and to unused tax losses.
Yeah. So, see here, sir, what happens is the policy needs to be very clear. And now from this year onwards, in fact, the accounting policy, it has changed from significant accounting policy to material accounting policy. So just by saying that, deferred tax assets and liabilities attributable to temporary differences is not enough. They need to clarify. So there are two types of temporary differences. One is called deductible temporary differences, which will be allowed as deduction in income tax in future. And the other is taxable temporary differences, which is basically tax as per income tax. So we create deferred tax assets on deferred tax assets on deductible temporary differences, and we create deferred tax liabilities on taxable temporary differences. So the policy needs to be clear. We cannot, shorten the policy by saying that, we create deferred tax assets and liabilities on temporary differences. That is not very clear when you write such policies. It has to be clear on what do we create deferred tax assets and what do we create deferred tax liabilities. One more example is, unused tax losses. Now, on unused tax losses, we either create deferred tax assets or we don't create anything. We definitely do not create deferred tax liabilities on unused tax losses. So that English was definitely not clear. And as an independent reader or stakeholder, one can get confused, are you creating deferred tax liabilities on unused tax losses? So, one needs to be very clear when they are drafting such accounting policies. It is not that you do it every year. It is that you create once and then you just, check whether it is still applicable every year. Or if it requires minor modifications, you do those minor modifications. So when you draft this accounting policy for the first time, you need to be very, very clear. So, yes, back to you.
I think in a very similar way, Himanshu Bhai said not to club all amounts into one, and Anand Bhai saying not to club all words into one. Wherever required, you can use more line items or sentences to ensure that the true spirit comes out.
Very important point, Anand Bhai. You actually mentioned one word which is actually debated across, and I am getting a lot of questions. And you three learned people who are here, I request you, it is out of the question which we are there. Kya bolte hai usko? Free hit. So this is a free hit for all three of you. Okay, Himanshu bhai?
Yeah, certainly. But what is that word you are talking about? What is that word you are talking about?
I'm coming there. It is basically, I am able to not understand what is this significant accounting policy. What is
material
significant
versus material.
Significant versus material account. And I want all three of you to just speak for 2 to 3 minutes on what
Okay.
is your take, and give your own example in whichever way you want, so that this deliberation
Right.
is going to come in a big way in time to come. And this is going to play a very important role from a financial reporting, which is going to happen now. Right?
Right.
So over to you, all three free hits.
Yeah. So let me try the first free hit. So last year, no, Ind AS was amended. Ind AS 1 was amended to change from significant accounting policies to material accounting policies. Now, the logic is not given by the Indian regulators, but the logic is available in the IFRS or in the IFRS or IAS 1 when they changed. And the logic was that the word significant is not defined anywhere. The word material is clearly defined in that IAS 1, and therefore it's easier for someone to understand what is material. The second logic was that it was always found that the companies as well as the auditors say that, okay, let us reproduce the standard itself, because then you are never going to go wrong anywhere. So if you have a revenue recognition policy, you will reproduce entire control conditions and all, which makes the standard just reproduced in the policies which are there. So what the change is that they said that let's forget significant, let's go to material. Don't reproduce the standard. Only give what is the basic policy which you are following. And again, if you look at the change in detail, it is not material accounting policies. What it says is material accounting policy information. MAPI as we call it. It's not just MAP, material accounting policies, but what is required is material accounting policy information. So which means that I don't need to reproduce a standard. I can only say that I am following something like this, which is in terms of a standard. To give you a live example, say for instance, there are companies which sometimes go into amalgamations or business combinations. Now every year they will not go into a business combination. So what now it means is in a year where you don't have a business combination, you can remove that policy. So far, everyone used to put that policy every year, whether it has or does not have a business combination. Take another simpler example, say an insurance claim. Insurance claim is a significant policy, but every year you may not have an insurance claim. Even in one particular year, if you have an insurance claim, which is say just maybe a few lakhs of rupees in a company with a profit of say 20-30 crores, you may say that yes, the insurance claim accounting is a significant policy, but it is not material to my financial statements. You can ignore to give these policies. And there are several such examples which are there. So the judgment which needs to be made is it something material to my financial statements? Is it something which is recurring? Is it something which if I don't reproduce in the financial statement, does it change the opinion of my readers? So it's a judgment call, but clearly the pages in the accounting policies are bound to go down when you follow this particular thing. And from the one or two results which have come in the last few days, the published results which have come, you can see some reduction in the disclosure of accounting policies. Now, of course, there are challenges also. In income tax, when you do your tax audits, all these policies may have to come back, because in income tax, they don't distinguish with anything. They will say, what is your policy on this? Next year, when you have a large insurance claim, you may have to bring back that policy. So there would be a repository of all your policies. And in a year when you have a materiality important, you bring that policy back in your financial statements. It's a very useful change which is made, but clearly a lot of judgment and I would say subjectivity will go into this particular selection.
So that means it's a complete 6. दोनों हाथों से छक्का मार दिया. The free hit effectively utilized. But one more thing which is very important, if Anand Bhai or Santosh, whoever would like to take the follow-on question, apart from this 6, you need to hit one more 6, which should have a taste of helicopter shot, which is what is the concept of year-on-year representation also on that. Sorry, thoda, I'm just deviating.
Very important.
But this is important. I thought it is something which we, free hit ka use kar lete hain apne log.
Why this is important is going forward in the FRRB reviews, then the queries would come down.
Yes, correct. So Santosh Bhai, I think you opened up now to speak. Over to you.
Yeah, so basically, absolutely. I mean, Himanshu sir summarized it pretty well. I think the reason why we have this change is because a few years back, ISB had taken up this project of outreach for the users of the financial statements, asking them whether in IFRS financial statements whether they are useful. And one of the feedback that they got is it's excessive. Sometimes even we find some of the balance sheets, and I'm sure the FRRB office would also find the sizes of the Ind AS disclosures very voluminous, and sometimes it's difficult to fathom. So the disclosure overload, they wanted to kind of rationalize it, and therefore they have introduced this concept of material. And as Himanshu sir rightly said, it is basically material or immateriality is something which we as auditors are more familiar with. Regulators. Now, if you look at the LODR or the SEBI regulations, there is a concept of materiality in that also, because related party or for various things. So materiality, the word material is better understood by the company, by the auditors, and by the regulators as against significant. What is significant for me may not necessarily be significant for you, and vice versa. So there will always be a judgmental aspect. So in that sense, this is a good change. And again, as Himanshu sir nicely summarized, there can be event-based materiality. Supposing last year I had an acquisition, this year or a couple of years later, I don't have an acquisition. So I will have to look at it, and I will have to strike through that accounting policy, because for that year it's not relevant. So every year, I think we'll have to, as auditors and as companies, we'll have to have a relook at, we'll have to spend 1 hour, 2 hour, 3 hour on the accounting policies. And that will also give us some opportunity, as Anand said, if there are some English improvement or there is, language improvement, we can probably do that also. Also, there is a regulatory aspect. So, for example, as Himanshu sir said, so let's say if I am a trading company and my fixed asset or property, plant and equipment balance is as such not so material. Still, because my depreciation which I use for financial reporting is something qualitatively, I may probably say that it's an important thing. I may still keep it as a material accounting policy information. Even if the balance of depreciation, the property, plant and equipment balance is still not very material, still the management, the audit committee, the auditors may prefer to keep it because it's something qualitatively it's material. So that's the way I would look at it.
I'll just try to add two things. I'll not.
Yeah, one point which we have missed.
Yes, sir.
So instead of 6, it has gone to 4. Only for one reason.
Is there a third, what is it? That
Third empire. Review.
That's primarily from a point of view of year on year comparative. When you talk about a material and non-material, whether example, if this year I had an impact which is there, and next year it is going to be again, there is no impact. Some examples which Himanshu bhai has taken.
No, but yeah, so let's say if there is a comparative period, let's say if last year there was a acquisition, a business combination, this year there is nothing, but still because I give comparative information also, my view would be that you would still keep it for one more year. Next year, if this year and next year, both the years there is no business combinations, then I would remove that policy. So if either current year or previous year, if that transaction or that event is there, then I would still say that we should keep that accounting policy until even in the comparative period, it is not there.
So
Yes,
that's
so
absolutely
Anand bhai-
right. That's absolutely right, I think.
So the third empire has given his answer. And so the last person who actually initiated this discussion should answer about this. मतलब जो initiate करा है पूरा discussion, sir, what is your thought on this?
Yeah. So firstly, I'll not like to repeat what Himanshu Bhai or Santosh has said already. Those are all facts, or those are all common. We agree on those points. So I would not like to repeat that. But couple of additional points I would like to say is one, in these policies now, what is more important or critical is how you have implemented these policies rather than the policy or the standard itself. So, for example, if there are certain options available or if there are certain ways of implementing that policy, say for revenue. So, one can say that revenue is recognized when control is transferred. But the right way to look at it is, giving a couple of more sentences about when does in company specific scenario the control is transferred. At what point in time does the company believe is the control transferred for its goods and services? Okay. So you have to get onto the specifics of the company, how that policy or the standard has been implemented, what are the significant factors which have been used in arriving at those policies. So that is the real context with which this material policy information, material accounting policy information was created. So that is very, very critical for companies to do. It's not a boilerplate copy paste of policy one. If you are doing 10 clients, you cannot simply copy paste to all those 10 clients. Even though that particular line item may be material for all 10, you just cannot copy paste. It has to be very, very customized, very, very specific. Okay. Secondly, many people come and ask, that what happens if I give all these policies? I'm giving more, I'm not giving less. So no one can, challenge me that you have not disclosed something. I am disclosing more. The problem there is the standard says that, there's no, so standard firstly allows you to give more policies. Okay. It does not say that you cannot give more policies, but it says that you have to ensure that critical information does not get hidden in too much of information. So how do you ensure that? If you give too many policies which are not relevant, which may not be material, which may not be, important for that understanding of that company's annual report, then the critical policies or the important things which a stakeholder should refer to, stakeholder will have to spend efforts to find those policies and may miss those important policies. And hence, giving extra is not the right solution or is not acceptable solution. You have to give what is required. You cannot give more than that. And lastly, on that question on year, which Santosh has already responded to, but the way I see it is, you have to see at a principal level. When I am reading an annual report, I am reading both the years. I am reading comparative year as well as current year, and I am comparing that. If an event has happened in the comparative year, I need to understand that also. And hence, all information relating to comparative year is also equally critical or equally important. Otherwise, if I don't understand previous year, I will not be able to compare it. So it will lose its comparability. So that's the principle which if we remember, then we'll be able to get to the right answers regarding these questions. Thank you.
6 हो गया फिर से. चलो
मतलब तीनों मिलके लास्ट एमएस धोनी की इनिंग्स खेल दिए. फर्स्ट 3 बॉल में 3-6 जो मारे थे. And
if I may just add maybe just one more kind of this thing to reiterate on the importance of this point. Basically, you all may recollect that last year NFRA issued a order to one of the listed companies. Generally, the order is to the auditors, but this was one of the listed companies, a very reputed listed company, wherein they mentioned that the revenue accounting policy is using the word fair value instead of transaction price, which is inconsistent with 115. So even these, again, it will be like an unintentional kind of a overlook by the company. But the point I'm trying to drive is this is an area that we cannot now, no longer afford to ignore, because many a times we, as I think Vishal bhai, you said, we look at the larger points than the finer points, but ये finer points भी अभी थोड़े address करने पड़ेंगे हमें.
No, I appreciate Santosh bhai what you mentioned, and definitely what Himanshu bhai and Anand bhai also mentioned, that this and thanks to Daya bhai for giving this free hit, because this was something very important, and definitely it would not have come out normally, because there are no financial statements under MAPI that are yet subjected to review. But I believe from preparers as well as the auditors, from both the sides, this is a very important change that would be required for their March 24 financials. Himanshu bhai, the next question to you, where we found in some cases that certain items of income and expenditure, such as leave encashment, dividend income, debenture interest, they have been recognized on cash basis. Is it possible for certain items of income or expense to be recognized on cash basis with a suitable mention in the accounting policies?
Okay, this is again something which maybe not the bigger listed entities, but a lot of smaller entities say that it is difficult to say account for things like say gratuity, retirement benefits on accrual basis. So I will account for it as and when I make that payment for it. Say a bonus which is there, mainly because the argument is to do a actuarial valuation is a big effort and cost, and I would rather account for it when I pay for it, because that also synchronizes with my tax aspect when I get a deduction of when I pay that amount. Unfortunately, however, if you are a limited company registered under the Companies Act, you have got this section 128, and so was the case with the earlier Companies Act of 1956, where it clearly says that the books of accounts have to be kept on accrual basis. So if these books are not kept on accrual basis, which clearly means all relevant items of incomes and expenses have to be accounted for on accrual basis. Now, whether it is say retirement benefits, whether it is bonus, whether it is insurance claims, whether it is something like sale of scrap, and I am giving you some of the common items which companies try to account for on cash basis. If such a thing happens, the auditor is bound to qualify his report saying that this Companies Act is not followed, first of all. Then secondly, some of the accounting standards are not followed. So it's a violation of 128, it's a violation of 133. And finally, the auditor will also have to say that proper books of accounts are not maintained, because it's again a violation of section 129 where books of accounts. So it's a multiple modification of your audit report. And if you look at again several ROC orders or orders of the ministry, they have actually penalized auditors for this particular case, where it is said that the accounts are kept on cash basis. So even a mere disclosure saying that this is kept on cash basis will not solve the purpose, because it clearly is a violation of several sections of the Companies Act. Actually, the change which has come in the significant and material may actually help you in this case, because you can say that all material items which are there are accounted on accrual basis, which means that something very small which is immaterial, you don't need to write it is on cash basis, but it can be understood or implied that the remaining items are on say cash basis, like sale of scrap. But you cannot write anywhere in your financial statements that so and so items are accounted on cash basis.
Right. I would just like to narrate one instance of non-compliance, or I would say where the preparers and auditors have to be more careful when the same disclosure is being made at multiple places. So this was a case where under related party disclosure, investment in equity shares was disclosed as a fellow subsidiary company. However, so this was under the related party disclosure. However, the same investment was disclosed as associate in the director's report. And in the third instance, in exceptional items, it was disclosed as wholly owned subsidiary. So it was viewed that contrary disclosures have been made in the same set of accounts regarding the nature of relationship with that company as to whether it is a fellow subsidiary, wholly owned subsidiary, or an associate. And such ambiguous and incorrect disclosures, they should be avoided. So this was just a filler. Coming back to Anand bhai on income taxes, a company has presented deferred tax assets and deferred tax liability separately on the face of the balance sheet. Can you guide us on the offsetting principles?
Sure, sir. So let me start with the principles first. So the standard says that deferred tax assets and deferred tax liabilities should be offset. If it is legally you are allowed to offset, that means at the time of when you file the returns or whenever that deferred tax will convert into current tax, you will be able to pay net amounts rather than pay gross and collect gross. So one is legal. Second is it should be within the same tax jurisdiction. That means if a company operates in multiple countries, then whatever relates to the same tax jurisdiction, that should be set off. And thirdly, same tax entity also. So if the tax entity is also different, then also you cannot offset. So three conditions are critical as far as when I see Indian tax law. I'll repeat. One is legally you are allowed to set off. Second, it should be same tax jurisdiction, and thirdly, it should be same tax legal entity. If these conditions are fulfilled, then you should and you are mandated to offset deferred tax assets and deferred tax liabilities. If I take an example of a company which is only operating in India, then it should only have net deferred tax, either net deferred tax asset or net deferred tax liability. But if we talk about a consolidated financial statements wherein there are entities, subsidiaries and all, so it can be possible that one entity has a deferred tax liability and another entity has a deferred tax asset. So at consolidated level, you may have deferred tax liability and deferred tax assets both. But in standalone entity of, standalone financial statements of an entity which is only operating in a single country, in a single tax jurisdiction, you should always present net deferred tax. Back to you.
Thank you very much, Anbhai. And now, question for Santosh. If Santosh is available, otherwise I'll go to. Santosh is back.
Yeah.
So, Santosh, there are very interesting situation which is going to come this year, where multiple tax benefits. The question is though specific, which is primarily with regards to the exemption of custom duty under Software Technology Park of India scheme or any other exemptions. Or any other benefits based on government schemes. Are they government grants? And if so, what are the disclosure requirements? Is one part. And second is, lot of listed companies this year has got PLI benefits. If you can, one is on the tax compliances or partial tax compliances with regards to the exemption on custom duty for STPIs. Second is the PLI. Are they government grants? And if yes, what is that need to be disclosed?
Sure. So, Dayanandji, see, as far as Ind AS is concerned, Ind AS 20 deals with government grants. Government grants are defined as any assistance that the government gives in the form of a transfer of resources to an entity in return for some compliance, either a past compliance or a future compliance with certain conditions relating to operating activities of the entity. As against that, let's say if there is a general benefit that the government gives to all the companies, that's not a government grant because that's a government policy. So if you look at it from PLI perspective, PLI, the conditions, there should be a pharma. It's an industry specific benefit. Only certain industries, units, certain companies get it, pharma companies or electronic, companies. And there are certain criteria within that also. You need to have certain, turnover. You need to have certain other conditions complied with. So in my view, PLI is certainly a government grant. As also even the software technology, the STPI units, again, that would be available only to certain companies who comply with the requirements of the STPI rules. So again, in my view, they would also fall within the definition of government grants. If they are government grants, then the next question is whether they are revenue grants or asset grant. And if you look at PLI, so what is the difference between asset grant and revenue grant? Revenue grant is basically it's a grant which is intended to compensate your additional cost or operating cost, whereas an asset grant is basically an asset specific or a fixed asset specific grant. And the accounting can vary based on, whether you classify it as a revenue grant or a asset grant. PLI, because it's dependent on sale and, the intention is to subsidize the operational cost of the companies, the beneficiary companies, in my view, would be a revenue grant. STPI, again, it would it would more likely to fall in the revenue grant categorization. As far as the disclosures are concerned, Ind AS 20 sets certain disclosure requirements. Basically, you need to give an accounting policy, or if the grant is material, then how have you assessed it, whether it's an asset grant or revenue grant. If there is a significant judgment that is involved, you need to disclose under the Ind AS 1 requirements. And also, if you have certain conditions which are, contingent to under the scheme, the PLI scheme, that disclosure, narrative disclosure, also needs to be, provided for in the notes to accounts.
Okay, so I have an overthrow to either of other two speakers. There's an overthrow. You want to take any run, you can actually think about Himanshu bhai, your thought, or Anand bhai, your thought. Just making it light. Otherwise, accounting people think it is more complex. So it is easy to. Himanshu bhai, any thoughts on your side? Because next question is going to come to you only. So overthrow is with you, extra run is with you, and again after the over is over, you will be batting on the pitch. So tell me.
No, all this several benefits which the government is giving, and this STPI, this PLIs is one thing. You also have a lot of benefits given for, say, your energy efficiency or something which are there. Clearly, you'll have to say whether the benefit is to meet your day-to-day running cost, or is it to meet your capital cost or something. And clearly that the standard on government grants will help you on that. Of course, that standard does give you several or two options also in some cases. But typically, if it's a revenue grant and PLIs are typically revenue grants in that sense, so it will have to get accounted as revenue on accrual basis, depending on how the conditions are satisfied or not satisfied. So that would clearly be what rightly was said by earlier speaker.
I think the curious case is that of EPCG schemes, the Export Promotion Capital Goods Scheme, where we have one IT, what is it called? ITFG, Ind AS, Transition Facilitation Group Interpret. One of the FAQs that they, rolled out, I think it was about a few years back, wherein they said that it's a matter of judgment, whether you call it as a revenue grant or a capital grant. So again, you can have a significant debate with respect to the classification also sometimes.
Yes, the reason of
talking about
please.
EPGC scheme, no, the issue therefore is that once you have imported something with a customs benefit and you have a commitment to export, now you have also exported, but the issues come up practically where you say that though you have exported, I have not uploaded things on the portal. Once I upload on the portal, I can get delayed. And there is also a time available to forego that or condone that delay which is there. So what is the time of accrual for that EPCC benefit? Is it when the government finally agrees to my benefit, or is it when I just export? Now, these are things in practice which do come about. And the view normally, typically we take is don't get into the procedural aspects. If you have in principle complied with the export requirement, please try and recognize for that on an accrual basis.
No, absolutely. I think in certain cases, we have seen in PLI schemes also, where if there is, so obviously it's a new scheme, PLI. And in couple of instances, if there are any non-compliance with the conditions, the government has gone, ahead and said that we want to take back the PLI benefit that we had given. So
Correct.
again, it can be a very, especially with some of these new schemes, it can be a very, debated and very judgmental kind of a thing.
Yeah, that was the reason which I linked PLI apart from the custom duty, Vishal bhai, because this year most of the people who are going to complete the financial statement, Himanshu bhai, you will agree that a lot of companies have got benefited and they are large, medium, and small. All category of people have got. I don't know what is the percentage, but the point is, a lot of benefit has actually been passed on from a different compliance point of view. And when do you
Correct.
recognize, when do you not recognize? What is the stage in which I say that, okay, well, if my self-declaration is satisfied or should be on cash basis, there are multiple added questions which are there. But I'll not get in there because I think I'll not be permitted. So there are a lot of things which come to my head also when we start discussing. But yes, I think the overthrow is done, and I again pitches back on your floor, your side, Himanshu bhai. That is
Yes.
with regards to a PLI, and also there is an additional thing which is very beautiful. From a abstract of accounting policy, it is picked up. Assets not owned by company are amortized over a period of 10 years. What additional disclosure should be made? So that is something which is very important.
So assets not owned by a company amortized over 10 years is frankly looks to be a very ad hoc policy, because when you are not owning the assets, and again this is again a very hotly debated topic, and EAC and all and the ITFG have clearly debated on this quite a lot. Based on the Ind AS 16 which is there, if you have an asset which you are not owning but which you are able to control fully or partly, you can capitalize that particular asset, but you have to amortize it over the expected life of that asset. Typical would be your, say, pipelines. Typical could be your access roads to your factory where others are also allowed to use it. So 10 years is frankly an ad hoc thing. You will have to base it on the life of that particular asset, which is a right to use asset not owned by you. And in case you are putting it 10 years, it will have to be justifiable. It cannot be a policy said all such assets automatically become 10 years in that sense. So a lot of disclosure would be required, that why do you take a period of 10 years? And unlike maybe a standard on intangible assets where it says that there is some rebuttable presumption, there is nothing like that in Ind AS 16. So whatever is the life you take, you will have to at least give some justification for it. And linked with your schedule 2 on the life of the asset, if the life is other than what is in schedule 2, in any case you need to say how are you considering that life other than what is given in schedule 2 rates.
Very true, Himanshu bhai, and definitely it is many times challenging, especially where, like you mentioned, to satisfy the criteria about assets which are not owned by the company, whether to be capitalized or not capitalized, and there are a lot of ESC opinions also on that. So I think that was a very important aspect. Anand bhai, on the income tax again. So you have remained on mute for a reasonably long time. So now I think reasonable word we'll have to change to significant or material. And so another company, in its accounting policy on income taxes, has stated that the deferred tax asset have been recognized and carried forward only to the extent of reasonable or virtual certainty, as the case may be, that the asset will be realized in future. So Ananda, can you elaborate on the words reasonable or virtual certainty used in the policy vis-a-vis the term probable used in Ind AS 12?
Okay. So firstly, all these three terms have their own different meanings. And most of the cases, you will find that whatever term used in the standard, has a different meaning. It is not same meaning. If different words have been used in the standard, it will always have some different meaning. So here, if I were to put something on the scale from 0 to 100, Reasonable is something which is, less than 50, more than say 20 and less than 50. If I put what is virtual, virtual is something which is more than 90. Between 90 to 100 is something which is virtual. And then comes probable. Probable is between reasonable and virtual, which is between 50 to 90. That is what is probable, means more likely than not. So the standard Ind AS uses the term probable, and hence companies will be required to use only the term probable. It cannot be reasonable, it cannot be virtual, it will have to be probable. The words reasonable and virtual certain are coming from accounting standards, AS 22. It is not coming from Ind AS. So the company will have to again relook at its policy and change it, align it with Ind AS and not with the old accounting standards.
Yes, I think Anand bhai, I think on a scale of 100, what you mentioned for probable, reasonable, virtual, I think that is something very important indication or benchmark that judgment can be made with respect to the recoverability of the asset, or I would say the on the losses. So coming to Santosh bhai, Santosh bhai, when can monetary items relating to foreign operations which are recognized in OCI be reclassified to the statement of from equity to the statement of profit and loss? And is it permissible that on repayment of monetary items as stated in an accounting policy?
Yeah, so Vishal bhai, in Ind AS 21, as also in AS 11, there is the concept of foreign operations. And of course, in Ind AS, we have the concept of functional currency, and any operation which has a different functional currency automatically becomes a a foreign operation. Now, when it comes to FCTR or foreign currency translation reserve that you have, or it can be anything which is net investment in that particular foreign operation. Let's say if you have invested in shares or a loan where the repayment is not, is not stated, or it's not expected also, some very long-term loans. As far as the requirements of Ind AS 21, as also in AS 11, we had the same requirements that you can only recycle the foreign currency, the accumulated part in the equity in the FCTR in your P&L at the point of disposal. You cannot do it even before that. So even if, let's say, you have a repayment of the monetary item, or if you have an impairment towards the monetary item, that also you cannot typically, the standard prohibits you from recycling it back to the P&L. You need to keep it accumulated in the reserve or as a part of the equity. Again, I recollect few years back in ASB, we had this discussion with respect to a bank, a large, PSU bank, which had a foreign branch. And, at the time of, remittance, they were planning to, they in fact booked profits on it. So again, the RBI had taken a strong, of course, there was a RBI circular also back then under AS 11 that foreign branches you need to compulsorily consider as integral. So anyways, but the answer is that this is a wrong policy, what you mentioned. It has to be at the point of disposal.
Yeah, thank you, Santosh bhai. So what you indicated was that the reclassification should be done on disposal of the investment rather than the repayment of the monetary items or assets. Himanshu bhai, when the review of a company was going on, there was an accounting policy on purchases that was disclosed. And so the question is that since there is a standard on revenue from contract with customers, the policy on revenue is disclosed. is there any need for disclosure of policy of purchases? Because we found such policy in some financial statements.
No, clearly this whoever has given this policy on purchases has, not really seen the standards which are there. There is no such policy which is required. I have to give a policy on revenue recognition. Purchases automatically get covered when I come to the standard on making provisions or accounting for my assets, liabilities, or on the normal accrual basis of accounting. And if you even look at the conceptual framework, it clearly says what is the asset and liability and what are incomes and expenses. So a purchase is accounted based on a conceptual framework itself. You don't need to have an accounting policy for purchases, especially not link it with my revenue in that sense. So I think this would be one of a very, very rare case where someone has given a policy on purchase. And maybe they are saying that for each item in my profit and loss, let me have a policy which is written.
Maybe yes, because you have employee benefits, you have inventories, you have revenue, you have depreciation. So maybe, and I believe one thing is typically because the method of accounting that is being followed, especially in the non ERP softwares companies, where you have a direct purchase that is booked, and then at a year end, you have the inventories that are accounted for. Whereas what we see as per the standard Ind AS 2, that all purchases are first inventorized and then the consumption has to be recorded. So indirectly, when we show the policy of inventories, there also with respect to purchase and all, many times we cover that in that way. So I believe it's also the method of accounting by which the preparers get confused that, since I'm booking the purchase first, I need to have a policy on that. But actually it is the other way around, maybe.
But you cannot penalize a company for doing that if otherwise all other policies is in place.
No, absolutely. I'm not saying that we are penalized. So, these are what we are sharing are the commonly found errors. So it's not about penalizing anybody. Himanshu bhai, continuing with you, what should be the policies relating to financial assets and financial liabilities disclosed?
So financial assets and financial liabilities, it would depend whether the financial assets are, say, in the form of investments, are they in the form of loans and advances? If they are in the form of investments, you have some options which are available. If my investments are, say, in subsidiaries or joint ventures, I have an option to go at cost as per Ind AS 27. Otherwise, typically I follow 109 where everything is at fair value through profit and loss. So it's typically at fair value through profit and loss or amortized cost, or in some exceptional cases, Ind AS 27 allows me that judgment which is there for investments. When it comes to loans and advances, it is typically either at amortized cost or fair value through profit and loss. This is how my financial assets are recognized. Liabilities, again, it's typically at amortized cost. So all my financial liabilities, whether it's loans or anything, is typically at amortized cost, which I would recognize. Liabilities at fair value through profit and loss is not something which is very common. It is typically at amortized cost. That's a very broad question, frankly. That's a very, very broad question because there are multiple accounting policies which you will disclose for both these things.
And now we are on the last 2 hours of our session because only 10 minutes left. So the 2 hours for me is 5 minutes slot of each. So now let us go to one more discussion. I think when we have talked about certain very important aspects, if you see, Himanshu bhai, the discussion what we had today in this almost 1.5, 2 hours, almost 2 hours of discussion, Santosh and Anand, both 3 of you, that the focus was we are trying to put is on the fundamental side, which is being generally ignored. Because most of the time what is happening is, and I think in examinations also it has happened, in CA examination particularly, we prepare for the toughest examination. When the simplest salary computation comes in, we are actually clean bold because we don't remember the provisions.
That's right.
So that's how actually the entire process has been. And there are a lot of companies which are moving from Ind AS accounting standard to Ind AS as well. And a lot of companies are coming under compulsory requirement with regards to the disclosure because of the subsidiaries, because of other factors which are coming in now. More importantly, Vishal bhai, the number of companies which are going for MSME IPO, and just they need to prepare themselves also for certain furthermore reporting requirements also in that regard. So the fact is basically we are just trying to put in together those thoughts that today we have close to around 1,300 people, if I am not wrong. The audience is large, and that has been continuously monitored, and we are really thankful for all those people who are actually joined
We
us.
have got very good questions.
And we have got very good questions, rather very technical, very interesting, which are going to be taken tomorrow, hopefully, because this basic discussion we'll hold it here, and the chairman will take it forward, and his thoughts will be put forward. But one question for Anand is basically on the borrowing cost capitalization. In an accounting policy of borrowing cost, it was stated that the borrowing cost directly attributable to the acquisition of fixed assets are capitalized as a part of cost of asset up to the date the asset is put to use. This is the above policy in accordance with the requirements of Ind AS? This is a very basic question.
So
Aap chakka maar lo aap.
Yes, sir. So put to use in the concept under Income Tax Act. It's not a concept followed under Ind AS or accounting standards. Ind AS goes by ready to use. So once an asset is ready for use, you have to capitalize it. Borrowing cost also goes by the same concept. You can capitalize a borrowing cost until it is under construction, which is until it is not ready for use. Once it becomes ready for use, you have to stop capitalizing the borrowing cost. You capitalize the asset as a whole and start depreciating it. When I say ready for use, the terminology used by the standard is ready for intended use or ready for use as intended by the management. So once, as the management intends to use an asset, if it is in that shape, whether you use it or not, whether you have actually put it to use or not, if it is ready, then you have to stop capitalization and you have to start depreciation. So that's a short answer. If I have a minute, I just want to add one more line here on borrowing cost. I have seen companies taking a stand that, if there is working capital borrowings or short-term borrowings, they don't capitalize interest on those borrowings as part of borrowing cost. They don't capitalize it in assets under construction. They also have a belief that, if they capitalize it, they are in a way saying that short-term funds have been used for long-term purposes, which can cause cargo issues. This belief is actually not correct. So accounting standard says that there can be two types of borrowings, and as we all know, money is fungible. Okay? So it's not that you have to specifically tag a borrowing to an asset. Yes, if it is specific borrowing, naturally you will capitalize it. But there's also a concept of general borrowings. Now it says that you might have put your own money into asset, but you could have used the same money to repay the borrowings instead of putting it in asset. Okay. So by that logic, it allows you to capitalize even borrowing costs relating to short-term borrowings. It need not necessarily be a long-term borrowing. And it's not just allowing you to capitalize, it's in a way mandating you to capitalize. So any borrowing cost you incur, if there is an asset under construction, it is mandatory for you to capitalize those borrowing costs to the extent proportionate of the cash you have spent on that asset. Based on that computation of weighted average borrowing cost, time period, and the amount spent. All those things you will consider, and then you will arrive at an amount which will be mandatory to capitalize. So, because I got this platform, I wanted to send this message. Thank you.
So, one thing, Anand bhai, I'd just like to add one very nice statement which was made in Hyderabad ITAT bench, right? Which made a statement, the bench member said, money has no color. So whether you use from here or you use from there, money has no color, though that statement stand good for certain facts, but that may not be applicable for all the facts at any given point in time. So this is something which we all have to understand, the differentiating point when you can actually do it and when you cannot do it. I'm hope Himanshu bhai, I'm right in that regard.
Absolutely.
So that statement was very interesting that I remember now, that money has no color. So
Right.
that I think will be an easy answer to remember and we can take it forward. Followed with a very interesting statement for Santosh for you. There is a very huge debate which is happening in the GST department these days. And this question relates to that. Rather, that comes from a different angle. I am just putting the new angle to it, which is actually an issue which has been seen by most of the companies, the consultant, the auditors. Vishal bhai, this is a very important one. This is with regards to the fact that as per the financial statement of holding company had issued corporate guarantee as a security for loan availed by a subsidiary company from financial institution. However, the subsidiary company has not disclosed. So this is from an accounting perspective. I'll also give you answer from a question from a GST perspective. However, the subsidiary company has not disclosed the details and terms of borrowing in the financial statement. Is there any accounting or disclosure required in case of subsidiary companies for this corporate guarantees? One is this part. Second, there is a huge amount of debate which is happening among the regulators that the holding companies, subsidiary companies, disclosure requirement, associate things, and all those things. What extent, because they are comparable, and what extent that comparison and the reporting is going in tandem between holding and subsidiary. So that is one part on the disclosure requirement. I hope I'm not making you confused on that side.
No.
One is on the disclosure side. Second side, there is a huge debate which has come and notices are coming to almost all these companies on GST payment. There is a huge amount of demand which has been created so that you may take or you may not take. But again, the reason why I'm talking is this disclosures with regards to holding subsidiary and the guarantees which are given, it becomes critical not only from your accounting standard compliance or Ind AS compliance, but also from GST compliance. So over to you, Santosh, for this.
Yeah, that's a good question, Dayanandaji. As far as the accounting, let me start with the accounting part of the question first. Financial guarantees, we all know it's covered under the scope of Ind AS 109 and Ind AS 32. So it's a financial liability from the perspective of the issuer, the guarantor, right? So here, what we are saying is the holding company has given guarantee to a bank on behalf of a loan that the subsidiary company has borrowed. As far as the holding company is concerned, there has to be an accounting for that. And there are at least a couple of EAC opinions and, there is no debate, frankly. There is no ambiguity with respect to whether holding company should account for it. And, there is a capital contribution and there is a liability that gets booked. From the perspective of the subsidiary company's standalone financial statements, I think your question is primarily from that perspective. There is no compulsion with respect to accounting for such guarantees from a beneficiary perspective. Ind AS 109 or Ind AS 32 does not deal with it from a beneficiary's perspective. Why? Because the loan is, as a matter of fact, sitting in the books of the subsidiary company. The subsidiary has to, in any case, repay the entire loan. The primary obligation of the loan towards the bank is that of the subsidiary company. So there is no additional liability that the subsidiary company has to book over and above that. The holding company has guaranteed this loan, and therefore, from the subsidiary's perspective, it's, if one can look at it, it's more like a contingent asset, which we generally do not, account for. We do not account for, not even generally, we do not account for. So from the accounting perspective, there is no compulsion for the subsidiary to account for it in its standalone financial statements. Having said that, since it's a benefit that you are getting from the holding company, you may have an accounting policy to account for it. And again, I think in one of the EAC opinions, we had dealt with it and we had come up with a proposed, acceptable accounting policy from a subsidiary standalone point of view also. Again, I repeat, there is no compulsion on accounting for the financial guarantee which the parent has given on behalf of the subsidiary in the books of the subsidiary company. So that is as far as the accounting is concerned. Disclosures, certainly you need to still disclose it, because somewhere in Ind AS 107 in one of the paragraphs, it requires that wherever you have borrowings, all the collaterals, all the securities that have been given as a part of that borrowing need to be disclosed. And of course, because it's a subsidiary who has given the holding which is given the guarantee, there is again a related party transaction angle to it also. So under both Ind AS 24 as well as under Ind AS 107, there are disclosure requirements. So either in the borrowings note or in the related party transaction note, you will have to disclose it that my holding company has given a guarantee on behalf of the loan towards bank so-and-so. So that disclosure has to come, whether there's commission payable, whether it's, charged, not charged, it doesn't matter. So as far as the disclosure is concerned, certainly you need to disclose it. Accounting is optional. The GST angle, आप बताइए क्या करना है? GST, there is, I think, this is again one of all the intercharge obligations, I think within the group, whether it's from a shared service, cost perspective or any cost allocation perspective, I think since last at least couple of years, I think many of the insurance companies, many of the, many companies have actually got this notices from the, from GST department. So again, from a regulatory perspective, again, there would be implication. The moment you have this disclosure, obviously it's a low-lying, fruit from a regulator's perspective.
No, Santosh, the point I think Dayanandji is trying to make is if you believe there is likely a GST notice which has come or a show cause has already come, will it amount to a liability provision under Ind AS 37? I think that also may need to be considered, because if you have got a show cause notice, clearly Ind AS 37 may apply, and whether you show it as a contingent liability depends on the circumstances.
The PPR analysis will have, yeah.
Yeah, but clearly, if you have a related party transaction in GST, the concept is that you take it at notional value. There is nothing like if you don't charge anything, you don't pay GST. And the notional value is defined at 1% on a guarantee if there is nothing else beside it.
Correct.
So the issue therefore is, will you insist on a company to make such a provision? Because clearly you will get caught sooner or later. That I believe is a dilemma which everyone is facing.
Yeah, at least if you have got a show cause notice, Himanshu sir, in my view, there will have to be a provision, if not a contingent liability, unless you have a very strong case and, if you have not got, and if let's say your industry peers or somebody else has got, and, therefore, so then there is probably a case for some kind of a general provision or, at least a contingent liability in my view.
And you can have to extend it even to transfer pricing under income tax, because once you have a show cause from GST and a provision made or something, you will also have a question of arm's length pricing for international transfer pricing. Now that also could be a probable liability based on several past decisions on that particular matter. So a guarantee is guaranteed to give you a lot of thoughts.
नहीं इसमें primarily Himanshu bhai, the value of service, certain people are considering that it is the value of security which is being given, and some people are saying it is only the commission which I pay for the guarantee. So there is again a different debate which is there. I just wanted to touch upon, because now the financial reporting framework, again I'll come back there. The financial reporting framework, whatever we talk in any sense, what behavior a regulator is actually having versus as an auditor when we are looking at, because auditors are different, might be for GST, income tax as well as statutory audit. Similar is the case with the regulators are different when it is a regulatory requirement on financial reporting, income tax and GST. So what is happening is somewhere that interplay has to come where all people have to work together in a cognizance. Like example, the third part which you actually raised on the transfer pricing mechanism, it's going to be a total different impact. And everything cannot actually, you cannot kill a company by putting all the provisions एक के ऊपर एक तो खाली provisions की balance sheet बनेगी, ultimately profit loss account बनेगा. So somewhere we need to put the discussion might be aside, but just to tell you guys that my name is Daya Nivash Sharma. So Dayanand also is Daya ka Anand.
Dayanand Saraswati.
Dayanand Saraswati hai. So that's not a problem. So
आपके मुंह से सरस्वती
so no, that was a pleasure.
My apologies for
Chairman.
this.
No, not at all. No
mispronouncing
apology.
your
light. You
No
made the
apology.
sentence so light that we have all got Anand from you, right? That's
Anand,
right.
that is more important.
No, I think it was a wonderful day one. And let me tell you, friends, that we had a bank of 100 plus questions and we've been able to complete just about 25 odd. And but the quality of deliberations, the responses that have been given, and I would just say to add to it that we have got a large number of questions from the participants also. So we look forward to meeting all of you again at 5 p.m. tomorrow. And let me just request on behalf of all the participants to the panelists here that we are sure कि कल अपना ये पेपर पूरा खत्म नहीं होगा. And maybe after a week or 10 days, we would once again request that we continue with this series just for the benefit of the preparers and the professionals, both because they have a lot of questions and we would definitely love to respond to them and to meet the objective of this webinar series. So once again, thank you to all the panelists. To the participants, to Daya Nivas Bhai and the office, Ankita is here and the whole FRRB team is here. And so, like it is said, Jayega Mat, a break ke baad, one night ke baad, tomorrow we are again meeting at 5 p.m. on this very link. See you and have a very good night. Thank you very much.
Thank you all. Thank you very much.
Thank you.